Hi everyone. Today I'm going to talk about finance careers, or what we actually do on Wall Street. This was originally part of a presentation that John and I gave to students last year. And even though we both went to Wharton Business School, a lot of what we learned about finance careers we didn't actually know until we started working. Hopefully, this is interesting and helpful if you know anyone who wants to work in investing. So, this is an overview of the finance industry. This is the overall finance landscape, and you can see I've divided it here between the sell side and the buy side. And the difference between the sell side and the buy side is on the sell side, you're selling or advising companies on financial transactions. So, for example, it could be advising one company on buying another company, or it could be helping an investment fund do a trade. This is the sell side. The reason it's called that is it's more sales based. Then there's the buy side. On the buy side, you're usually investing. You're investing your money or someone else's money, and it could be in all types of investments, from stocks to entire companies to loans. So first, we'll focus on the sell side. Most of the time when you start your career in finance, you start on the sell side, and that's where you get a lot of your training. A lot of people have probably heard of investment banking, but it's also not immediately clear or obvious what investment banks actually do. Investment banks mostly serve two functions. They either help one company or firm acquire another company, which means they're advising one side on buying another company, and they're charging an advisory fee. So they're not actively risking their own capital most of the time, but they're actually just helping by providing financial advice. It could be modeling, it could be legal help, it could be transactional help, it could be how strategically, whether it makes sense for one company to acquire another. So, for example, you've probably heard in the news that TikTok is facing this issue where they might be banned in the US if they're owned by ByteDance, the Chinese parent company. So I guarantee you right now, TikTok probably has multiple investment banks advising them on potential US companies they can sell to, or to spin off TikTok from ByteDance to avoid the potential ban. So these investment banks serve as lubricants or middlemen within the industry, helping connect buyers and sellers and hopefully adding some strategic advice along the way. A second thing that investment banks do is they help raise money. So if I'm a company and I want to raise money, or if I'm a fund and I want to raise money, I can't just go out into the world and tell everyone I know saying I need money, because that creates a very disorganized process and also violates some financial regulations in the US. So instead, they use investment banks who basically help connect the people who need money with the people who provide money. The next large category on the sell side is sales and trading. This segment does exactly what it sounds like, which is they help funds execute trades and present potential trade ideas to these funds. So careers on this side consist a lot of figuring out how best to execute a trade on behalf of the buy side. Why do you need this service? Because if you're selling $100 million or even $1 billion of stock, you can't just sell that into the open market. The reality is you probably need someone to tell you how to portion your sales and to find potential buyers for you as well. Similarly, when you and I, so typical consumers, sell stock, a lot of the times we're also getting help along the way from something called market makers in the finance industry. So even though it seems like this could all be automated, it's actually quite manual behind the scenes. And that's what sales and trading helps a lot with. Finally, there's equity research. So equity research does a bunch of research on industries and businesses, typically for large funds. So they'll give industry reports on, for example, the semiconductor industry, and they'll send that out to all of their clients on the buy side. And then those firms can then do trades with the bank sending them equity research. And as a result, the bank makes money on the sales and trading side by sending out oftentimes free research. So this is an overview of the sell side. There's other small branches, I'm sure, that I'm not quite covering because this is a general overview, but most of the time you're starting along one of these three paths when you begin on the sell side. Then let's talk about the buy side. So a lot of the times the path to the buy side is you spend 2 years in banking or a few years in sales and trading or equity research. And then eventually you might go on to start actively managing money, and that happens more on the buy side. So let's give an example of some of the firms on the buy side. One example are hedge funds. Hedge funds is a very general term for investment funds that hedge. Hedge meaning you might be long some stocks but short others, and the short provides a hedge to de-risk the long. Let me give some example strategies on the hedge fund side. One is long only. That means you're usually buying stocks, holding them for the long term, and sometimes you can also classify mutual funds as long only. A lot of mutual funds might only own stocks and not short stocks. Then you have long short hedge funds. Long short hedge funds will often do something called run delta neutral. And that means they're long and short the same amount of stocks in specific industries. Maybe you're long NVIDIA and short AMD, both semiconductor stocks. And the reason you may want to do this is semiconductors, they might move up a lot or might move down a lot. And you don't want to be exposed to that overall industry risk, which is if semiconductor chips crash and you're only long stocks, meaning you only own stocks, then in that case, you might lose a lot of money. But if instead you're long $100 of NVIDIA and short $100 of AMD, you're expressing a specific view on these two companies. You're not just taking an overall industry risk. So the idea is if semiconductors as a whole crash, you're not worried about the movements in the overall industry since you're long and short similar amounts of industry-specific stocks. A third investment strategy, which often goes along with long short, is you have industry-specific pods. So you might have one specific group within an overall larger fund that focuses on tech, one that focuses on healthcare, one that focuses on energy. So by having these industry-specific pods and specializing more, you tend to be able to find and know the specific investment opportunities in that industry better. A fourth investment strategy is quant, which is a much more quantitative approach to long-short analysis, or other strategies as well can fall within quant. There's things such as momentum, where you're taking directional views, such as if a stock is increasing a certain amount or an industry is increasing a certain amount, there's a probability that it might do the same thing for a certain period of time before reverting. Fifth investment strategy is activism, which is you're actively taking a large stake in a company and you're trying to push through management changes or specific actions. Oftentimes, this could consist of stock buybacks or giving out dividends or selling underperforming divisions. And an activist would usually take a 5 to 10% stake to try to push through some of these management changes. So a well-known activist you might have heard of, for example, is Bill Ackman or Carl Icahn. Finally, there are macro strategies as well. And these usually mean you're taking a global view on where the economy is going. And you can take views on where different economies are going. So, for example, you might have a view that we're going to have much more inflation in the US. And as a result, the value of the dollar is going to fall relative to the euro or some other currency, or versus gold. Maybe you own gold because as the value of the dollar decreases, the value of gold or the price of gold increases. So that's an example of taking large macro views. So all of these are different strategies at hedge funds. There's also credit, which is instead of investing in equity, you're investing in debt. As a general overview, debt tends to be slightly less risky than equity because you're paid back first. So, for example, if a company goes bankrupt or a house, for example, is foreclosed on, the debt or mortgage owner gets to take control of the house and the equity owner gets wiped out. Debt has a first claim on the value versus equity. Some of the credit investment strategies include giving out private loans to companies. It could be buying the bonds of companies. It could be buying distressed debt. Distressed debt meaning buying the debt of a company in bankruptcy with the intention of taking the company through the bankruptcy process and owning the equity of the new company. Or there's also venture debt, which is you're loaning money to slightly earlier stage, riskier companies. One that I haven't listed here is oftentimes you can also loan money against assets. For example, you can loan money against houses, against equipment, against accounts receivable at a company. You can loan money against even wine or art. So there's a lot of different ways to structure loans, and most of that falls within the credit landscape. Then there's private equity, and private equity consists of usually buying a company with equity, but then taking on debt. So similar to buying a house with taking on debt, private equity, you buy a company while taking on debt, and that way you can increase your returns with leverage. So a lot of the times you might do leveraged buyouts where you end up generating returns by paying off debt, by increasing the profitability of the company, or selling at a higher price than you buy by increasing the valuation of the company. Finally, there's venture capital and growth equity. So on the venture capital side, you're often making smaller equity investments, so smaller check sizes in very fast growing companies. For example, most of the big FANG companies you've heard of today did take on venture capital money at one point in time. It's a lot more network driven and relationship driven than some of the other buy side opportunities. There's also a segment of venture capital and growth equity, which is growth equity, where you're not investing right when this company starts, but actually investing in the later stages of a company. So when it's starting to grow and when it's starting to scale. So maybe when a company has already reached $50, $100 million in revenue. Finally, there's a segment of the buy side called proprietary trading. Oftentimes here, you're trading very quickly. If you're market making, you're basically trying to collect small spreads. You don't want to make a directional bet, and you just want to do small arbitrages along the way. How you make those spreads worth more is you take on leverage. You take on leverage on the back end so that what was once a small 1% clip here or there then becomes 10% with leverage. But there's a lot of different quant strategies. Some are also potentially more valuation based, where you're trying to find stocks that are cheap. It's a very broad category. Okay, I hope that was a helpful overview. This is a very abridged version of the finance industry and some of the different categories of working and investing on Wall Street. In terms of some of the pros and cons of Wall Street, I'd say one of the largest pros is in many ways, you're paid to learn. You're paid to learn about new industries, learn about new investments, and a lot of the times you do keep on learning new things. And you also develop a pretty high level view and think about things quite strategically in terms of how a business may want to run. Some of the downsides, of course, are you're not actively working within a business, so it can at times be a little bit lonelier of a career than working at a larger corporation. A lot of the times you're taking a more passive view, which is you're not actively making changes at a company. Instead, you're just investing on the theory that a company maybe is undervalued, or you're shorting because a company is overvalued. So you're not directly having an impact on a company. There are some investment firms, such as activist funds or private equity, where you're making more concrete decisions about a company. But again, you're not quite getting your hands dirty by getting into the nitty gritty of the details. Usually, instead, you are an investor as opposed to an operator within a company. So hopefully this was helpful. We'll do more videos like this in the future if people are interested in these topics. Thanks for listening in. I'm Nick, and I've worked in finance for almost a decade. If you enjoyed this video, please give it a like and follow our channel for future videos. You can check out our WeChat group for more wealth and retirement tips. Talk to you next time. Bye.